it is, in fact, in New York City where I live. The office is in Jersey where I am now. St. Patrick's Day. I neglected to factor that into my travel time this morning after I had a meeting in Manhattan. I had to drive out to New Jersey, and I left enough time to get here. I did not leave enough time, taking into account St. Patrick's Day crowds and traffic. So I apologize for that. I don't think I've ever held a webinar on St. Patrick's Day, at least not here in New York. It is, I remember when I was driving a taxi cab in New York, the one day that I would not drive was on St. Patrick's Day. Between the traffic and the crowds, it was an impossibility. So, the topic that I chose last week or so when we scheduled this webinar has been a little bit superseded by the events post-Friday in Japan and how they've played out in the markets. But I think there's some applicability there, and so we're going to talk about both. One of the key factors that we have seen in the entire market reaction to the events in Japan, well, we've seen twofold. The enormous amount of volatility in primarily the equities, but also somewhat in the foreign exchange market, provided, of course, you don't count that fascinating stop run in dollar yen last night, which I'll talk about in a little bit. In general, the safe haven trade, the dollar, if you look at the peculiar aspects of what's been going on with the safe haven trade, it has not flown to the dollar through this entire episode with Japan. Let's take a look at the yen chart, the euro chart here. This is a daily on the euro in March. Does anyone see any safe haven trade there in the dollar? Certainly say from here, which is Friday, to here. In fact, the euro's gone up. There is absolutely no safe haven trade there, and there are a couple of reasons for that, but I'll talk about it in a second. Let us look at the Aussie. No safe haven trade there either, although you can make an argument that the dollar side of this is a safe haven, but I don't believe that. What's going on here is twofold. It started with questions about the Chinese economy, which didn't really play out. Biggest purchaser of raw materials and goods from Australia. And it went on to the generalized view that the Japanese problems, the Japanese earthquake, the tsunami, and the problems with the Fukushima reactors will damage world growth. Damage to world growth, lower resource utilization, lower use and demand for resources out of Australia. Now, playing into that, of course, is where the Australian dollar was. And if you were long anywhere on the way up or long above parity, then almost any reason is a good reason, frankly, to take profit or to cut your potential risk on the downside, since that's such an unusual level and historical level for the currency to be at. Sometimes when the market builds up strongly on one side, it doesn't take a great deal of an event to get the market moving in the opposite direction, and a lot of that is positioning. If I was long at 101 and almost anything other than, a 3% unexpected rate increase by the Bank of Australia would have had me looking over my profit shoulder to protect that position. And I think we have seen some of that right here. Look at these daily moves here. This one right here, we have a three-figure move from the top to the low in the Aussie. That's something we haven't seen in some time, and that was on Monday. No, yesterday, sorry. That was, what's today, 17? Today, 17. That was on Tuesday. And that has continued since then. So there isn't any safe haven aspect here. I don't think the dollar is sponsoring this, is on the other side of this move. It's just that the Aussie is reacting to developments in the real world, and the dollar is the other side of the trade. Let's see, the only true safe haven we've had through all of this is right here, the Swiss franc. Now, there is a historical aspect to the Swiss franc safe haven status. Swiss banking secrecy. I worked for the Swiss for many years, and it was certainly one of the selling points of accounts in Switzerland, people who did their business in Switzerland and who did their banking through the Swiss system. That has declined somewhat because there is so much more movability to funds, but also because various other governments have gone after the Swiss banking secrecy regulations and pierced them in a number of ways. It's much harder to use Switzerland to protect your money from your own avaricious governments, and they're all about of that case. But this, in fact, is still a safe haven status. Now, the thing about, because we're looking at a rise in the Swiss franc, because remember, this is, of course, quoted dollar Swiss, which means when it goes down, the Swiss franc goes up. The Australian dollar is quoted on the empire side, so you're quoting in Australian dollars. So when it goes up or down, it's what actually happens with the Australian dollar, and the dollar's on the other side. In that case, the Australian dollar is going down and the U.S. dollar is going up, but it's not a U.S. dollar trade. It is an Aussie dollar trade. This also, now this could be said as a safe haven aspect to be a Swiss franc trade rather than an anti-dollar trade. But because think about what the position of the Swiss economy. If this is reacting to the same type of thing, the same event, the same series of events that has moved the Australian dollar down, in that case the US dollar up, here we have exactly the opposite position in that, the exactly opposite move. We have the dollar going to absolutely historical lows against the Swiss francs. I mean, when I was trading, the Swiss franc was usually 120, 123, 125, go down to 118, 116. This is a number of years ago, back in the late 80s and the early 90s. Nothing had been ever seen like this. This move, and we can look at the days in which it took place, 14, 15, and 16. And you want to count, this one would be 11. So this is, in fact, the Japanese earthquake, Japanese tsunami. Excuse me one second. People in my office sometimes. I have a window in my office and somebody just looks in and goes, "What are you doing?" So, doing a webinar. They came in anyway. The Swiss franc here versus the dollar cannot have any real economic sense here. Is there any sense? I mean, you can look at the Australian economy and say very frankly and very clearly, the economy is going to be under much greater risk and probably not nearly as prosperous with a overall fall in the world economy. Now, you can take the other view, of course, is that as Japan rebuilds, they're going to need more things from Australia. That's not the point of view the market has taken. The market is responding to the probable generalized depression. I just mean depression as in variable change in the world economy from this catastrophe and the series of catastrophes in Japan. That's the view the markets have taken, very logically so, of the Australian dollar. Well, can we take the opposite view that somehow the Swiss economy is going to benefit from the same event? And yes, I see that comment. Yes, I think there is some view in that, but not as strong as this particular move back here. This particular move, the last 4 days, is tied exclusively, I think, on this chart and on the Australian chart to the events out of Japan. For the comment on the chat that could the U.S. move because of the Middle East, yes. And I would say that's part of the generalized trend here if we go. Because remember, I mean, look at the events we have here. The events in the Middle East really stem from the beginning of February, the end of January. And we had a rise in the dollar against the Swiss franc and then a fall in the dollar. The fall in the dollar, this section here, I would say probably is tied to the problems that higher oil prices are creating, and this chart is almost exactly tied to the movement in oil prices. Coincident, not tied, coincident, but I would say tied as well. And that's part of this thing right here, and that is true. That is a safe haven move, I would say, to the Swiss franc because the same logic applies. Does the Swiss economy in any fashion stand to benefit from an increase in oil prices? And the answer is no. But does perception of the safest place to put your money, if the world economy does get much worse, does that apply? And the answer is yes. And I think we're seeing the same thing here in a greater degree. There's a much greater degree of psychological based movement in what we've seen since the tragedy, I will call the event, the earthquake in Japan. There's a great deal more fear here. We also have a new event. The markets habituate very, very quickly. They're like the sense of smell. The sense of smell habituates very quickly, meaning if you smell an odor, 5 minutes later you will barely smell it anymore because it habituates. The sensory system gets used to it and stops counting it as an input. Well, you have a very, very similar reaction in markets. Markets respond most to the unexpected and to the new. They aren't necessarily the same thing, but in this case they are. But the more times the same thing happens, the less response you get. We saw this absolutely in the European debt crisis. When Greece got rolling, the markets didn't quite freak, but they certainly paid attention, and the dollar safe haven was a big mover. Less so under pressure from Ireland. Same thing here. The oil prices became a priced-in factor of the markets, and so without a new development, you're not going to get new movement. And whether Mr. Gaddafi stays in power or not is not enough of a new development. And it turns out that Bahrain itself and the problems there have not turned out to be that much of a new development. Part of that, of course, is because they have been swamped by the events in Japan. But for Japan, the threat of I don't know enough about Switzerland's banking laws or policy to have an opinion on that. I do, in general, respect the right of countries to run their own financial system. But I do not have an opinion, certainly right now, for the interplay between two different countries when they have differing interests financially. Meaning that if someone sends their money to Switzerland for a specific reason to avoid, say, American taxes, I believe that is universally recognized as something that probably should not be. However, the right of people to be private with their own money, yes, is something I respect and think is a good thing and something that should be retained. But back to where we were. The dollar safe haven and world events. What is actually moving markets these days? Were there any statistics out today? Yes. Did they matter? Not very much. And statistics have not really mattered very much for the past 2 years. When things get slow, they'll pay attention to statistics again, but without central bank rate cycles, we're not going to get much movement, and everything has been swamped time and time again by the events out in the world. The specter of a nuclear cloud wafting its way around the world is one that really does get the fear and psychology factors moving in the markets. But a very interesting fact there are a couple of interesting facts about this. Clearly, this is not a widespread, let's put it another way, let's take one step back. I mean, I'm looking at the Dow right now. The Dow's up 130 points today. I was driving in most of the morning, so I didn't have a chance to look at the news stories, but I can bet that there isn't that much new, dangerous news out of Japan. There was a very critical, or at least worrisome article that got a lot of press yesterday by David Sanger in the New York Times, and it was quoting, and this was after the comment from, I can't pronounce the man's name, but the EU Minister for Energy, Commissioner for Energy, I think is what he's called, who said that the Japanese were close to losing control of this. That got a lot of play yesterday afternoon. It was one of the things that drove the market into the free fall in dollar yen. And I'm going to talk about that because I have a lot of experience in the interbank market, and I used to run the Tokyo trading desk for Credit Suisse, both Credit Suisse in New York and when I moved to Singapore, Credit Suisse Singapore. That move yesterday, although from a fundamental point of view may be hard to explain, is a very, very logical, natural event that I saw time and time again in the Sydney market. When New York closes, the New York banks stop quoting, and I will, I will bring up the yen chart when I talk about it. I just want to finish some things here, and then I'll talk about the yen, which I think is probably fascinating for the traders amongst us. I hadn't seen a move like that in some years. It was more than a three-figure move from top to bottom, from 79.80 just before 5 o'clock. I think we actually posted this on Twitter. One of the traders on our desk came to me and said there are huge stops lined up below 79.80. And I got it posted both on our Facebook page and on Twitter, and not 2 minutes after I posted it, it was off to the races in Sydney. But I'll talk about that in a minute, and I'll gladly show you the charts that apply. And yes, it's been an all-time low since then. Don't forget, all-time low since 1973 means all-time low, period. 1973 is when Bretton Woods fell apart, and that was the fix to the gold at $35 an ounce, and everything was convertible. So this is the modern world floating rate period. There is no other time that makes any sort of rational sense. I suppose we could see what the yen was in the 13th century, but it might be kind of hard to peg it. I'm not even sure they were using the yen in those days. So this was the all-time low in dollar yen. But back to the psychology of the market. It becomes more and more difficult for the market. The market requires greater and greater stimulus, as with any habituated reflex or any habituated sense, to gather the same response. And that's what we're seeing here. That's one of the aspects of the response to. I can't say any, Harry, I'm sorry about that. I can't say anything about the leaders and people who keep their bank accounts in Switzerland because I don't actually know anything about it. I don't know where all of these people keep their monies. I know the popular conception is that they all send their money probably to Switzerland, but I really don't know that. And so I really can't comment on that. They might as well just send it to Riyadh. Again, I don't really know where Mr. Gaddafi, Mr. Mubarak, ad infinitum keep their personal funds. And I couldn't say anything sensible about it. Sorry about that, but I may have worked for the Swiss, but I never lived in Switzerland, although I did visit quite often. The markets are having a habituated sense of what is happening. And this is one of the reasons you got such a strong reaction from the Japanese events. But it's also true that the event was a fearful event on the surface of it, even if. Now, we all can remember back to Chernobyl. Well, most of us can anyway, including myself. Chernobyl was a much more dangerous and less controlled. What is my opinion of future energy? Let me address those questions in a minute. Let me just finish what I'm saying here. And I really do appreciate the questions, and I like them, and I'm perfectly happy and pleased to answer them in the course of what I'm saying. I never really want this to be a lecture. I prefer much more that it's a question and answer, which keys off things that I say. The specter of a nuclear cloud wafting across the world is one which excites a great deal of fear, even if it is not a realistic fear. The accident at Chernobyl was far worse. The design, that reactor actually exploded. Chernobyl, the plant was built without a containment system. Not even possible in the West, but in the Soviet Union, things were different. And even so, the dangerous levels of radiation really did not extend beyond 30 or 40 miles from the plant. Now, 30 and 40 miles is a big deal. And there was plenty of much lower level radiation throughout parts of Europe. But as a genuine fear, that's true. You're right. And I'll say a comment on that. That's true. But the Chernobyl reactor blew up. These reactors cannot blow up. What's happening in these reactors, when the earthquake hit, there's an automatic system in these reactors. These are actually GE reactors. They're built by General Electric. And they're 40 years old. I grew up near one in Westchester, north of New York. There is, I believe, there's a nuclear plant at Indian Point, which is about 30 miles from where I grew up. It's one of the oldest plants in the world. It probably has a boiling water reactor just like these reactors. But what happened in the earthquake is that the automatic systems immediately inserted the control rods into the reactor. It stopped the reactor cores. It stopped all of the fission. So there was no new uranium fission, or I think one of the plants actually uses partially plutonium, which is a far more toxic substance than uranium. So the control rods were inserted into the core. The fission reaction stopped, but there are many byproducts of fission reactions, and they generate a tremendous amount of heat, and they have various half-lives. That's the issue that's being dealt with in both within the reactors and in the containment pools where the spent fuel is stored. The heat that's generated, if not controlled. Harry, thank you for that. Yes, I mean, this is part of my point in all of this. The fears that were driving the markets are not terribly realistic. Now, I have friends in Tokyo, and I am not downplaying both the fear and the real danger. But the idea that these reactors will produce a far worse catastrophe than Chernobyl is simply not true. It's simply not true. The issue here is that if both the cores and the containment pools for the spent fuel, if they're not cooled, they will melt down. The fission products that are still there take some weeks to cool down, I believe. Has to do with the half-life of the products. Now, I'm not enough of a science student to go into any more detail than that, but the problem is keeping them cool. If they're not cool, what happens is then the cladding, the outside metal that contains the actual fuel melts, and there are chemical reactions between the products and the air. They create hydrogen, it creates explosions, and you get releases of the radioactive particles, both particles meaning not particles, but actual emission of rays from the breaking down and the deteriorating fission products, and small little bits of the fission products become part of the air in the explosion. So that's what the issue is there. But it is being sold, and the headlines are awful. And they are overstated for the actual threat. I actually had an email back from finally, after a couple of days, from a friend of mine in Tokyo. And he said, no, they're not leaving. Management's not going anywhere. They work for, I forget which, I probably shouldn't mention. I know who she works for. Yeah, it probably is. So the psychological aspects here is very much what's driving the markets. Now, for a case like the Australian dollar, it is interesting, I think, and we're seeing this more and more, how fragmented the currency markets are becoming. We're not seeing a generalized dollar move here. The dollar is moving one direction against the Aussie because it's the Aussie that's moving, and the dollar is moving in entirely the opposite direction against the Swiss because it's the Swiss that's moving, and the two reasons are different. The Australian dollar is moving because of the potential for a decline in its economy because it's not going to be, because a generalized fall in the world economy means less use for Australian resources. The Swiss franc is rising and the dollar falling because there's a safe haven factor here that's not flowing to the U.S. dollar. How do we know it's not flowing to the U.S. dollar? Oops, that's the Aussie chart. There's the okay, let me put up the Euro chart. That might help. We can look at the chart and say, compare this to the history of the past 2 years. This is fall of '08, right here. There was certainly no hesitation then about piling into the dollar for safe haven. We can look at this year. Greece to Ireland. There was certainly no hesitation there. Actually, Ireland's over here. Sorry. There was certainly no hesitation then for piling into the U.S. dollar as safe haven. And what are we looking at now? Nothing. Now, we can say that some of the difference is the nature of the two crises. The previous two moves that I just outlined were crises based in a financial system, in whether or not the euro would survive. And that relates directly to another currency in the world system, and that is the dollar. And so if you're worried that the euro was going to collapse, you would naturally buy the dollar, and the only other currency that could handle those flows would be the dollar. Now, I think the situation is very generalized. I mean, the move in, I have a gold chart here. Unfortunately, I do have a gold chart. I'm going to look and see what happened in gold. Now, this is interesting as well. Look at this. We're getting a fall in gold, which is an absolute emotional trade normally. As fear rises, people pile into gold. Yet we're seeing a fall in gold. Now, you could, I suppose, tie that somewhat to the fall in the dollar. There is some effect there from the pricing. And we're getting a rise in the Swiss franc. Is one the safe haven trade and one is not? Or are the aspects of this in the markets not really affecting a safe haven trade? And that would probably be my argument here. Safe haven trades are trades that depend on fear, or as I put it another way, I said this when I was on the tube as well, because I was on CNBC last week, and what they talked about, what the anchors were interested in, was what is going on. There's no safe haven trader. This was on Friday, after the Japanese earthquake, and CNBC was doing a lot of coverage on, of course, on the Japanese earthquake and its ramifications. And so I sat at the anchor desk for about 20 or 25 minutes, just watching and listening before we actually got to the segment on currencies. And what we were talking about was the safe haven trade. And the point that I made then is the same point that I'd make now. The safe haven trade is essentially a capital preservation trade. When there is enough fear in the markets that people are actually worried, as somebody I heard say this morning, not about return, but return of capital. Not return on capital, but return of capital. That's when the safe haven really gets rolling. And in the financial crisis, there was palpable fear that anybody who was holding financial instruments stood a very good chance. It didn't turn out to be true, but unless you, of course, owned General Motors stock. Turned out to be, the fear was very real, that things were going to actually implode, and financial instruments, unless held in the most secure, and nothing is, of course, guaranteed. The world collapses, there are no guarantees. But things held in financial instruments. So if you held, euro bonds or euro deposits, and the euro collapses and the euro disintegrates, then what is your value going to be if you hold it in euros? A major driver relating directly to the currency market. So we saw a real safe haven trade then. Also, the same could be said for all financial instruments at the time relating to the U.S. Treasury market. And the two were very closely allied at the time. A similar reaction, of course, based specifically in the euro, which is the largest trading pair, in the two bailout run-ups for Greece and Ireland. So you had a specific move then, but that's specifically related to the currency markets, because we were talking about the euro in the second two and about the overall survival of the world financial system in the first. Now we are not talking about that, and we are absolutely not seeing a safe haven trade in the dollar, or another way to put it. If you are worried about what is happening in Japan and its potential for the world economy, then the currency markets are telling us there is no choice to be made between the euro or the dollar. If anything, it has seen, I think, some spillover from weakness against the dollar in other currencies, primarily here. Because what effect does this have, of course, when the dollar falls so dramatically against the euro? And I will talk about this because it's fascinating, and I just want you to understand what happened here. I know I've spoken about this before. I've actually made some webinars on this. But I think for retail traders, this kind of move is a bit of a mystery. How it happens and why it happens and when it happens. All right, when does it happen? Look at this. I am absolutely shocked. Right at 5 o'clock, it took off. And I'll tell you all about that in a couple of minutes. We don't want to run on too long here. It's already approaching 45 minutes. So what we're seeing here is a spillover from... No, not a swap. What we're seeing here is a spillover from this move reverting back to the euro through the euro yen, and I'll tell you what I mean. When the dollar yen falls like this, it drags down dramatically the value of the euro yen. Okay? There are far more yen at that point per euro. But the move was not generated by a change in the relationship between the euro and the yen. It was generated by stop losses in dollar yen. It's not stop. Let me tell you what it is. Believe me, it's not stop hunting. I know that's a pejorative turn in the markets. Let me get to that in 5 minutes, and I'll tell you exactly how it happened. I used to do that. I ran the Tokyo shift for Credit Suisse, and also for Bank of Bermuda. So this is something I'm very familiar with, and something I used to do. So let us look here for the euro-yen chart. Okay, so what we're seeing here, and here is the hourly in the yen, covering yesterday's stop run. Here is the hourly in the euro-yen, same time frame. Guess what we're looking at? The same chart, essentially. And you can see the difference here. This is the hour. This is the hour. Okay, you can see that it's the same chart, more or less. But look at the difference at the end. The yen weakened again. This didn't. Why? Because to compensate, now the two cross rates are a mathematical product. The cross rate's a mathematical product of these two, of the euro rate and the dollar yen rate. So when the yen goes down dramatically, it drags down the euro yen. But the reason that the yen went down had nothing to do with the euro yen. And this couldn't help itself. It's a stop. But as you see, the euro yen has come almost back to the level of where it was at the beginning. In fact, it came right back to the level right here. Okay, even above where the stop run started yesterday. But how can that happen if the value of the yen, dollar yen, is so much lower? In order to compensate that simple multiplicative change, the euro must rise. In other words, if you're multiplying two sums together to get a constant sum and one goes down, then the other one must go up to compensate for it, to keep the cross rate at the same. That is what happened here. And that is the major support, I think, for the euro and why the euro is rising and has risen over the past day or two. Now, I haven't actually checked the figures to see how well this is borne out, but clearly there is no generalized safe haven run to the dollar, period. So, we have to go back and think then, if there's no safe haven run to the dollar, we can see this, because it's not rising. If the move in the euro is not really safe haven related, because it's really based on the recalculation over time of the euro yen, because the dollar yen fell for reasons extraneous to the market, then should we not also go back and question, and we have another piece of evidence here too, that is the gold. Gold is lower. If the market were truly freaked in general, not just the currency market, but everybody, about the approaching end of the world because of the nuclear reactors in Fukushima, then would not gold be rising? But it's not. So the only safe haven reaction we have here that we can look at and say this could possibly be a safe haven reaction. Certainly, as I spoke earlier, the Australian dollar or dollar rise is not. I haven't looked at the sterling yen. Yes, but what usually happens is because sterling is worth so much more per dollar, and these are all transmuted dollar rates, that you have a 1.6 factor on the sterling yen. Well, it's not quite 1.6, but you have a higher factor on the euro yen, on the sterling yen as opposed to the euro yen. Meaning that to keep things in equilibrium, you have to move farther against the sterling. You're right, 1.5 to 1. I was never any good with math, that's why I'm in trading. So you always get more exaggerated moves, pip-wise, in the sterling yen than you do in the euro yen. And that has to do with the mathematical relationship of each currency to the dollar and also to the yen. So, if we're looking at so all the things we're examining here, we're looking for. I don't think that I have not seen anywhere that the BOJ has been in, and if there's a more inept central bank in the world than the BOJ, I don't know about it. I am being told that I have to end in 4 minutes. Sorry, folks. Okay, so let's deal with the. They're not getting any support on intervention. Every government in the world is trying to do the same thing, and secretly they're all pleased that the Japanese yen is so much stronger because it means their currency is weaker, and all these governments think that they're going to be able to export their way, including our own, that they're going to be export their way out of this, and they're not going to be called to account for what's going on by their electorate. That is not going to happen. Okay, let's just look at a 5-minute chart in the yen. Now, what is actually going on here, and why did it happen at 5 o'clock? At 5 o'clock, the value day changes, but that's not really the key. At 5 o'clock, New York banks stop quoting. The liquidity goes down dramatically, and that was said by someone earlier, Donkey. Donkey's the call name on here, and that's absolutely correct. The liquidity drops dramatically in the foreign exchange market and the interbank market at 5 o'clock. It actually starts dropping at noon when the Brits go home. But, Boyke, which question? No, I don't think so. I really don't. I think what happened, I think the thing that really caused the panic, the move in the yen was a stop run. When you get to a level like that markets haven't been to before, there are enormous amount of stops lined up there. People who need to sell for whatever reason. In addition, there is a tremendous amount of repatriation going on here. That stuff was put in there as well. These companies know that they need to buy yen. They need to sell dollars. I wouldn't say 80, yes, but the prior low had been 79, 76 or something, if I remember. So they broke through the all-time low. You're going to get a move like this in the all-time low. Okay? So you have all of these stops lined up. Now, what does a stop mean? Stop means that when I'm the currency trader, and I used to do this, sitting on the desk, I've got orders to sell because they're going to need the money. The insurance companies and all of the companies that have damage are going to have to spend money to make good that damage. They need yen. Dollars don't do them any good. They may own New York stocks on the New York Stock Exchange, but they have to bring the money home so they can use it and spend it in Japan. So although the BOJ said there's no evidence of this, or somebody in Japan said that I think is nonsense. Of course they are. And they're going to be doing it to get as many yen as possible for their dollars. So if they had done it on the 11th, they would have gotten a better rate than they did yesterday. So that's really what's going on. Now, how much? Nobody really knows, because it's very difficult to track this stuff through the currency markets, and there aren't any figures in the currency markets anyway, except the ones the BIS put out, and those are at a long delay. So nobody really knows. But that is the only thing that logically makes any sense, because there isn't any logic to buying a currency of a country that has been devastated. There's no logic to that from an economic point of view, from a fundamental point of view. Yes, the Japanese are going to spend a great deal of money, but replacing damaged goods does not grow the economy. Okay, so at 10, now all the bank traders are sitting on their desks and looking at their order book. And their order book are saying, and remember, the banks work so that initially, as the order is executed, it becomes the position belongs to the trader. So if I'm sitting on the desk and I've got $100 million stop order for one of my customers to sell it at $79.70, I know that when it touches $79.70, I am long $100 million at $79.70. And if I don't get rid of that real fast, I'm going to lose a whole lot of money because the customer wants to be filled at the level or within a pip or two. So I know already, this makes for a very, very nervous afternoon. But I know already, now this is 30 or 40 points away. it's not that easy to get out that kind of deal quickly. And as the liquidity dries up as New York goes home and the banks stop quoting, it becomes harder and harder and harder. I don't want that $100 million. I lose $100,000. I lose like $1 million every time it goes down a figure. So if I don't get rid of that, my P&L and the bank's P&L is going to get slaughtered. So the banks will execute as quickly as possible to get this stuff out of the way. That's what drives a stock market like that. And if I'm sitting on a Credit Suisse desk and I know I've got $300 million in stops at a certain level, I know that everybody else on a major money market desk has got the same book. Because as we all know, the view of the technical levels is very uniform across all markets, everybody looks at the same information. You, me, Credit Suisse, Deutsche Bank, everybody's got the same. So that is what happened. So it was the reason you don't execute earlier is because you can't. Right? If your customer has an order to stop sell $100 million at 79.70, right? If you execute that order, well, if you go short as a trader to protect yourself against the execution at 80.10, and then it doesn't go down, which is unlikely but always possible, then you're sitting on an enormous position that belongs to you, and you're probably over your limits for the bank as a trader is allowed to. Traders are not just allowed on currency desks to open up $100 million positions because they feel like it. They can't do that. So you have to time your execution so that the likelihood is that the order will then also be executed and everybody's happy. In a situation like that, I can guarantee you nobody's happy. So that is what happened yesterday. It was a typical standard. I've seen it many, many times. I've been in the middle of that kind of run many times. I am being told by my proctor that I must end. I apologize for that. I find this topic fascinating, and I do find it very, very interesting for retail customers because it seems that something extraneous, if you will, plotted is going on to take advantage of the markets, and it's not at all. It is simply the way the interbank market executes. So I thank you all very much for your attention. I will be doing another webinar next month. If anyone likes, I do tweet. You can find me on Twitter under my name. We also have a Facebook page under FX Solutions. I tweet 4 or 5 times a day, depending. Take a look. I'll be sending out some more tweets today. Thank you all for coming, and thank Vicky and Maud for tolerating and arranging. Thank you all very much. Have a good afternoon, and we will see you next month, or you can see us on our Facebook page. Take care.